Welcome to the Accounting Profits and Prosperity Show. I am your host, Louis Prosperi. We have a great guest for you today. He is a renowned speaker, business strategist, and an accomplished author who's written many, many books. Today, we are going to talk about his 80/20 sales and marketing book. Please welcome to the show, Perry Marshall. Perry, welcome to the show.
It's great to be here. Thanks for having me.
Perry, I am extremely excited. I've just consumed your book 80/20 and I can't get enough of it. Actually, to be quite honest, I did the Audible first, then I bought the book. So just to let you know, that's what I did. But what I want you to tell our audience a little bit about, how does the 80/20 rule work?
It is the most powerful thing that they should have taught you in grade school, but probably never did. And I don't know whether they taught it to you in accounting school or not. But
Well, no, they didn't, Perry. No, they didn't.
It says that 80% of what you get comes from 20% of what you do, and 80% of what you get comes from 20% of what you do, and so on. It's fractal, so it's recursive. You can just keep adding 80s and adding 20s. So that means that half of what you make comes from 1% of what you do. It's really profound. And once you see that it's true, you can't unsee it. And it's true about money, but it's also true about rabbit populations and the size of craters on the moon and traffic on the roads in your town, and most any spreadsheet and most any business. And 80% of the foot traffic in your carpet is on 20% of your carpet. It just goes on and on. And when I discovered 80/20 for real, I'd heard of it before then. I think everybody's heard of it. I didn't really get it. When I first really got it, my brain just about melted. And I was sitting in a coffee shop. I was reading a book. I jumped up. I'm like, wait a minute, is this right? I had to go home and start looking at stuff and verifying. An hour later, my wife comes home and I'm laying on the floor. I got a calculator. I got all these papers all over the floor. I was about a year and a half into my first business, and I was looking at the web stats and the client invoices and everything. I'm like, oh my word, this is true. This has always been true. Never noticed it before. It's always going to be true. You can use it to predict the future, not just look in the rearview mirror. And ever since, it was about 20 years ago, it completely changed everything that I do in my approach to business. It's become the backbone of millions of dollars consulting and coaching and seminars and books and things in my business career. And a person who understands 80/20 can almost instantly be a business consultant, be a business process consultant, or improve marketing. It's true in advertising. So if you're doing something like Google ads or Facebook ads, every report, every spreadsheet that's generated is all 80/20. It also means that probably 10 to 20% of whatever you're doing is making you negative money. Like, you would make more money if you didn't do it. You would make more money if you fired 3 clients. If you picked the right 3 clients and just fired them, you'd make more money than you made before you had the clients, and you wouldn't have to do the work.
I like that. What I want to do is, you mentioned something earlier on, which I really want to talk about. It's kind of the underlying multiplier in 80/20, which was the fractional component. And you used a perfect example using the Fortune 500 analysis, right? You took the top 500 companies of the Fortune 500, and then you said 20% make 80%, and you kept going up. And I'll let you explain it better than I will. So tell me how that worked and how the fractional multiplier works in 80/20.
Let's take the Fortune 500. I'm just going to, off the top of my head, I'm going to take a wild guess that the smallest companies in the Fortune 500 are probably a couple $1 billion,
Right?
Give or take. Well, if the 500th largest company is $2 billion, then 1/5 of the companies make 4 times the revenue, And 1/5 of those make 4 times the revenue. And 1/5 of those make 4 times the revenue. So if number 500 makes 2 billion, then number 100 makes 4 times that.
That's 8.
Yeah, so that's 8 billion. Number 20 makes 4 times that, which is 32.
Yeah. Yeah.
And number 5 makes 4 times that, which is,
now we need a calculator. Yeah, I got it.
that ends up being about right. And it's because it's a power law distribution. And there's a whole bunch of things that work like that. And so, for example, one of the examples in the book is what I call the principle of the $2,700 espresso machine. If you have a coffee shop and you sell 1,000 lattes for $5, which is $5,000, one person will spend $2,700 on an espresso machine. And it's like a law of physics. It's not just some weird anomaly that somebody would spend that much money on a coffee related item. It's virtually a guaranteed certainty. And not only that, if your business doesn't sell an espresso machine, Starbucks will probably just put you out of business. And it's because of a law of economics. It's not because Starbucks is Starbucks. And if you do a cost accounting and you go, where does the profit come from in this business? What it tells you is the lattes merely keep the lights on, and all the profit is from selling the espresso machine. And then there's a little cherry on the sundae. And you know what the cherry on the sundae is? You don't need any new customers to sell the espresso machine. The existing customers, one of them wants to buy that espresso machine, and they will. And if they don't buy it from you, they will buy it from somebody else. And if they're not buying it from you, they are buying it from somebody else. And so you need that premium offering just to make a business actually work.
So that's interesting. So basically what you're saying is he has these customers and one of them is going to buy the espresso machine. So one of his customers, if they won't get it there, they'll get it somewhere else. And that's probably the same with professional firms is if you don't offer the premium offers or the high-end service in your model, they'll keep buying the coffee from you, but you're going to lose out on the premium service. That's very interesting. One of the other things that you talked about, which is your rack the shotgun rule. And what I thought about it was, and then there was another section is when you're trying to determine, these are all disqualifiers. You talk a lot about disqualifiers rather than qualifiers for customers. And the reason why I'm bringing that up is because accounting firms or accountants, we like to help people. We like to solve problems. So we don't like to disqualify anybody, right? We're on the other side. We want to qualify as many people as we want. But according to you, that's the wrong approach. If you can elevate and see why this is much better, and also better customer service will come out of it.
So let me tell you a story about that. True story. My friend John Paul Mendoza, when he was 17, he hitchhiked to Las Vegas from Denver, and he got a fake ID, and he became a professional gambler. And he's literally going around the casinos in Vegas, playing poker and living by his wits. And after a few weeks of this, he was like, no, this is harder than I thought it was going to be. Maybe I need more gambling books. So he goes to a gambling bookstore and he bumps into this guy named Rob who runs a professional gambling ring. And they get into a conversation. He says, so could you teach me what you do? And he says, for a percentage of your winnings, I can teach you what I do. And so they make a deal and they shake hands. Jump in the Jeep, John. We're going for a ride. So they're going down the highway and John says, so how do I win more poker games? And Rob says, you have to play people who are going to lose. And those people are called marks. You want the kid that just got here from Wichita, Kansas with his grandmother's inheritance money, and he thinks he's going to get rich. You need to play poker with that guy, not other professional gamblers. And he goes, so where do I find people like that? And he goes, here, I'll show you. Pulls into a parking lot of a strip club. He walks him in there. There's lots of distractions in this club. And he sits John, there's loud rock and roll music. There's people drinking, sits him down at a table. This guy carried a sawed-off shotgun everywhere he went. He pulls it out of his jacket. He holds it under the table. He opens a chamber and he slams it shut and it goes, ch-ch. And in the middle of this loud club, there's a few people that hear that noise and they're like, whoa. What was that? And the owner comes over, hey, what's going on over here? All right, just teaching the lad a lesson. John, did you see those biker dudes that turned around when they heard that noise? And John says, yes. He says, don't play poker with them because they're not marks. Play poker with everybody else. Well, in marketing, everything you do is racking the shotgun. If you put an ad in the newspaper and some people respond and some people don't, that's rack the shotgun. And if you send out an email and there's going to be a Zoom call and some people get on it and some people don't, some people listen to the podcast and some people click on the link and some people bought the thing. All of those are rack the shotgun, rack the shotgun, rack the shotgun. And most people, when they sell anything, they are so obsessed with the people who didn't respond, which is most, that they almost tend to ignore the people who did. Like, well, that was too easy. And, if I could just work a little harder, that's backwards. What you really want to do is you want to work more with the people that are effortless. And furthermore, you need to have criteria of what actually constitutes a good client. I gave a keynote to a room full of CPAs about 8 or 10 years ago. I said, how many of you have that client? And it's like April 13, and he gives you this shoebox full of receipts, and he sends you 1,000 emails, and he's only paying $300, and it's a giant fire drill. Like, all of these hands go up. I said, so I, Perry Marshall, best-selling author, give you permission to fire that client. Now, you don't have to be mean and nasty, but you can send them a letter. My board of directors and I had a meeting, and we're changing our strategy a little bit. And there's just certain accounts that we're not going to be able to serve this year. And unfortunately, we can't handle your business anymore. But here's a list of other accounting firms, and we'll be happy to send the paperwork over. And you just got rid of this pain in the butt client. Like, you make negative money doing his tax return for $300 and answering 64 emails. It shortens your life. Like, the day you were born, there's no law of the universe that says the day he was born that you guys were like, the stars say that you're supposed to hook up and you're supposed to do his taxes. Like, you get to have the clients you want. What kind of clients do you want? When your gut or your sixth sense or your spreadsheet tells you that's a bad client, don't take them.
I like that. And let's talk a little bit about the 5 power disqualifiers or qualifiers, whichever way you want to look at them. If you could just give us an update on the 5, because I think those are a good way to start so that even for our profession, we can identify with these in different senses, because I really like them. If you mind just going through them a little bit, that would be great.
So John, the rack the shotgun guy, when he left Vegas, let's be honest, he was basically in a professional crime ring for 3 years. I mean, this is what it really was. And a certain point came where he was sitting in a restaurant booth and 2 guys were arguing, and one of them pulled out a gun, and John just realized, dude, if you don't get out of this life, you're going to be dead. And so he walked on, and he gets a job at this computer company. This is in the 80s. Somebody gives him a stack of 200 leads. And he says, I want you to go meet every one of these people. And John, he was only 21 or 22, but he already knew there's no possible way it's worth my time to meet all 200 of these people. I've got to ask them the right questions. I should probably meet with 6 or 12. And he came up with this list of questions. It's called the 5 power disqualifiers. And it's the 5 things that are always true anytime anybody sells anything to anybody. This is a really ingenious list. And here's what they are. 1, they have the money. As elementary as that may sound, I spent years trying to sell stuff to people who didn't have the budget. They didn't have the money. No matter how times you sing Kumbaya, they're not going to have the money. So you just stop and you move on. They have the money. Number 2, they have a bleeding neck. Like, there is some urgent issue of why they want to do business with you, and it has urgency. Number 3, they buy into your unique selling proposition. Why are you different than all of the other accounting firms in town, like you do these 506 government thingies or you do whatever it is. Number four, they have the ability to say yes. There's many sales situations where the person can say no, but they don't have the authority to write a check. In B2B, this happens all the time. They call you in, you go have a meeting, you do all these PowerPoints, but the person who is deciding whether to write a check or not or to approve the purchase isn't even in the room. There's no point in having that meeting if that person is not able to talk to you. And number five, it fits their overall plans. And so if you internalize what I just said and make it your set of rules, it completely changes your posture as a business professional, because now you're not chasing people anymore. You've got a list of 5 things, and if they don't check all 5 things on the box, you're not even going to give them a sales pitch. And when you really believe that and understand it, because it is true, they are not buying from you unless they check all 5 boxes. Do they have the money? Do they have a sense of urgency? Do they buy into your way of doing things as opposed to everybody else's way of doing things? Now you're not chasing them. And it totally changes the psychology of the sale. And I'll give you an example of this. So I have a Google ad book, a Facebook ads book, a YouTube ads book. When we came out with the Facebook ads book, Facebook was very early days. It was only 2011. Advertising program was brand new. And the honest truth was probably only 15% of business should even have been using it at all, because their targeting wasn't very sophisticated. And if you weren't a nice match, it just wasn't going to work. And so literally on page 2 of our book, we said, go to this website, take the Is Facebook for Me quiz. It's going to give you a score between 1 and 10. And if you don't score at least a 6.5, just go get your money back for this book and do not even do this. Don't waste your money. Now, anytime you do that, and the person in the audience or the person reading your book or reading your magazine article or your blog post, they can clearly see you're saying, if you don't check these boxes, just go away. Don't even call us. It immediately tells them that you're not chasing people, and it increases your authority. So a person gets a 5 out of 10, don't even bother. A person gets a 9.5 out of 10. Not only should you buy our book, you should sign up for our training program. You should get a consultation call. You should probably pour jet fuel on the fire to get this thing going. So that sales and marketing is not a convincing people process. It's a disqualification process. And I think this is going to resonate with accountants and bookkeepers and CPAs, because you guys aren't salespeople.
No,
and you don't like
not.
chasing people around. If you have a set of criteria and you have permission, I don't have to do business with you. I don't even have to pitch you. If you don't check the boxes, it takes a load off of your shoulders.
And honestly, in today's world, in our world right now, with capacity issues and hiring issues and having too many customers, having the ability to do a disqualifier so that you're only focusing on the customers. I like the part where you said that fits your process, which honestly, a lot of professional accountants do the same work, but they have their own processes. They have their own way of doing it. Even though we kind of say that accounting services are similar, each firm, because of the professional expertise, knowledge base, and the way they're set up, they are unique in themselves, right? So I kind of like that. If you incorporate that in the front end, that will save you so much time. But also the customers that come in will be at a higher customer satisfaction because they'll be happier, because you've kind of made them fit your model, not you fit their model. I really like that. That's fantastic, Perry. Here's something that you did mention, which I'm not sure if a lot of accountants do this, but the power of a guarantee in the sales process. You mentioned like that's something that you put in, and it's not like you put like one word in it. You focused on it. Not only did you focus on it, I got the impression that generally tends to command a higher price point and a higher value to the customer. Can you explain that a little bit more?
Yes, so people typically associate guarantees with like consumer products and mail order and stuff like that. And it's very rare do expensive professional services come with guarantees. If you have a guarantee and you define one, it hyper focuses on who your ideal customer is, and it really puts skin in the game. I have a friend who got into the pharmaceutical valve business, and he did something that is virtually unheard of in manufacturing. Pharmaceutical is one of the most conservative industries on earth, and they were selling bioactive medicines, which meant that if any contaminant got into the medicine, it could kill a patient because it was injected into their veins. And so they're selling these $4,000 valves that go on a tank in a factory that's making this. And Tom made this guarantee, and he said, if our valve is contaminated, if we ship the wrong one to you, if it's late, if it doesn't work the way it's supposed to, we will pay a union electrician to come to your facility, rip out our valve, we'll buy our competitor's valve, and we'll put it in. And he actually had to make good on that about 4 times a year. And to make good on that cost about $40,000 on a $4,000 valve. He was spending about $160,000 a year servicing that guarantee. So I'm just telling you the downside up front. So you get this is really serious. Well, this required them to get all of their processes just squeaky clean in every possible way. And over a period of several years, he went from smallest company in the space, competing against $100 million incumbents, to 90% market share. Like the whole market shifted over to him. And so in the context of a professional service practice, my favorite way of formulating this is if, then, else guarantee. Number one, if you are the right kind of client for us, which means you're the right revenue, you're the right number of employees, you're the right industry, your tax needs meet certain parameters that we're experts in. And the second if is you as a client have to cooperate with our process. You can't just throw your shoebox over the wall and expect us to perform a miracle. We are going to need things from you. And here's what those things are. And if you give us these things, then you will. And then now it's a promise. We're going to save you $100,000 more on your tax return this year than you would, and we will defend it against the IRS if this gets audited. Or else I'll refund half of our fees, something where they know that you have skin in the game. What this does is it perfectly defines your ideal customer. Who could you make that guarantee where you specified everything they need to give you and who they are? You can do this in your sleep and you're not going to fail because your process is squeaky clean. And now you can go up and down the street promising the right client the $100,000 less taxes than anybody else this year and be completely truthful about it. And I do this with every kind of business you can imagine. And sometimes it'll actually end up with a literal guarantee. And sometimes it just helps define who the ideal client is. But I always encourage people to have some kind of a skin in the game because the truth of all business is the client is taking a risk by choosing you. When you won't guarantee anything, what that says is, okay, so you say that this is going to go fine, but you're not willing to put any skin in the game to assure me that it's going to go fine, which means that when I switch accounting firms, it's actually going to be 6 months of torture before our companies are working together correctly. And you just did a nice dog and pony show and you seduced me, and now I'm angry at you. It really defines your process. And it defines who you're never going to do business with. How many of you have had a client where they won't cooperate with your process? They won't give you the paperwork on time. They won't give you the right filing or the right reporting. Some employee did something they didn't tell you about, and now they want you to defend it to the IRS.
Yeah. You've talked to a few accountants, I can tell based on our conversation. Or you have a lot of accounting friends, I'm not sure, one or the other.
And I've had bad experiences with accountants as well. Why do you have a bad experience with accountant? Because they'll take anybody in pants.
Because they want to help people, Perry. That's the end result.
And they're not charging enough. So like if you're getting your ideal client, you
Yeah.
can charge 50% more and everybody still be happy, including you.
I'm not disagreeing. We are really good at what we do, but we didn't get a playbook on how to build the right practice and how to pick the right customers. So that's why you're here, Perry, for us to help
Well,
give us
that's exactly right.
feedback.
Accounting
Yeah.
school didn't prepare you for that. And
No.
this is the brutal part of being in any professional services business is the guys in college, they didn't tell you this was going to happen.
I really like that. There's a couple of things that I want to get through before we run out of time. One is really the thing that I liked about you, where replace failure with testing, because from a professional perspective, failure is a bad word for us, right? Testing's okay. So how do you get a professional's mindset when it comes to implementing, like what we're talking about is finding the right customer, producing the right disqualifiers. How do we do that where we don't, if we do it once, we don't think of that as a failure, but we think of it, that's test one. How do we get the right mindset for that? Because I think that's really critical, because from my conversation with you and from reading your book, it's not do it once and it's perfect. It's test, 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 perfect.
Most anybody who is new in any profession, most things seem like voodoo, like the parts you don't understand. So when I got my first sales job and I'm scrapping around and I'm trying to get in to see clients, and I got this boss named Fred who I didn't even know how he got away with saying some of the things that he said to customers. And they would go, "Oh yes, that's right, Fred. Thank you very much." And I'm like, I could never say that. How did this work? And in sales, especially the old school kind, well, it's just a numbers game. You just got to smile and dial. It was just awful. I mean, it was just brutal. And I discovered the direct marketing people, and the direct marketing people had this other way of thinking about it. And the way they thought about it was, well, we're going to send out 1,000 letters and 250 of them have this headline and 250 is some other thing and some other and some other. And we're not going to like bring any moral judgment to this. We're just going to send them out. And we're going to see, variation C did twice as good as all the other ones. So now we're going to do that. And it got me to think of sales and marketing as a process and a procedure and something that was repeatable. Like if I do repeatable actions, I will get repeatable results. And I just look at it as I'm going to methodically and systematically try different things, and I'm just going to look at everything as a test. I'm going to try A, and then I'm going to try B, and I'm just going to see what works. And it took a lot of the angst out of it. Well, I'm going to run these 2 ads, and we're going to see which one works. And that applies to anything. And I think a lot of us, we think that failure is some part of our identity, when in fact it's just the outcome of a set of systems, and we need to change some part of the system. Maybe it's a different customer, maybe it's a different day of the week, maybe it's a different ad, maybe it's a different deliverable, and let's just try stuff out. And it takes a lot of psychic burden out.
Well, I kind of like that idea. Take it from, don't think of it as a failure if it doesn't, treat it as a test. When you're testing something, the result is not automatically considered a failure. It's a discovery point, right? It's not a failure component. It's like, what did we find out and how can we make it better? I really like that approach. I really love that chapter. That was really insightful. With 80-20 rule, do you have to have a certain size of customers? Do you have to have a certain size of company? Because professional firms don't have, and I'm talking about a small professional firm, like 1 or 2 partners, not necessarily the bigger ones, right? Where the size of the customer base could be anywhere from 20 to 200 customers. And on the personal tax, can be from a 1,000 to 5,000. But is there like a minimum component to use the rule? Like when does the rule become effective and when is it not effective?
Anytime you're dealing with more than about 5 or 10 of anything, the 80-20 rule kicks in. If you have 10 clients, I can just about guarantee you 3 of them are writing you more checks than the other 7 combined. By the time you got 50 or 100 clients, probably the top 10 are worth more than all of the rest of them combined, especially if you're selling them what they actually want. And if that's not true, it means your clients have itches that you're not scratching, and you need to ask, what is it they really want? Because I'm not even selling it to them yet.
Right.
And that's a great question to ask.
By the way, we're out of time, Perry, but thank you so much for joining us today. I really enjoyed this. And to be quite honest, I need another hour with you at least. But anyway, just for the audience that's watching today, if they need to get a hold of you or want more information, where can they go?
If you go to sell8020.com, SELL8020.com, you can buy 80/20 Sales and Marketing in the United States for $7, including shipping. If you're outside the US, it's $14, including shipping. So we're taping dollar bills to the book. And we do that because when I get on a podcast and we get in a professional practice like this, we get great clients out of those. And I want this book in your hands. It'll change your life. It'll change the way you think about business. And sell8020.com. And Louis, really great to have you in this conversation. I appreciate it.
Yeah, me too. Thank you all. And thank you, Perry.
Thank you.
Perry, once again, thank you for joining us today. And to you, our valued viewers, we thank you very much for tuning into this episode. We kindly ask that you subscribe to our channel, and we always welcome your feedback and comments below. Until next time, remember to stay hydrated, never lose your curiosity, and above all, stay well.